Something is happening inside Canada's economy right now that most people are not paying attention to. And by the time they do, it might already be too late to fully understand what went wrong. Canada just closed out the year with a contraction that nobody expected to be this severe, and what is sitting at the very center of this economic storm is something that sounds almost too technical to matter until you realize it touches absolutely everything, from the food on store shelves to the jobs in warehouses to the numbers on your paycheck. Now let us talk about the human cost, because numbers on a spreadsheet are clean and abstract. But what is happening to real people in Canada and the United States right now is anything but clean. 2 million Canadian jobs depend directly on goods exports to the United States, and that number is not a projection or a forecast. It is the documented reality of how deeply integrated these two economies have become over decades of shared trade and shared prosperity. And now that integration is being used as a weapon. Manufacturing employment in Canada has already shed roughly 58,000 jobs since the tariff conflict escalated. And those are not just statistics. Those are people who drove to work on a Monday morning and found out their plant was cutting shifts or closing a line. Those are families in Windsor and Hamilton and Oshawa sitting at kitchen tables trying to figure out how to cover a mortgage when the paycheck that used to feel stable suddenly does not show up the same way anymore. Automotive assembly plants across Ontario have announced layoffs and production cuts, and in communities where the auto industry is not just an employer, but the entire identity of the town, the psychological weight of that is crushing. You grow up in a place where your father worked at the plant and his father worked at the plant, and then one morning a president in Washington signs an executive order, and within weeks the whole structure of your life starts to shift. And here is what makes it even more painful for Canadians. They did not ask for this fight. They did not provoke it. They built one of the most cooperative and mutually beneficial trade relationships in human history with the United States, and then watched it get torn apart, not because of any failure on their part, but because it became politically useful for someone else to tear it apart. The 25% tariff that Trump imposed on Canadian goods is projected to cost Canadians approximately $1,900 per person per year, and that money does not disappear into thin air. It comes directly out of household budgets that are already stretched thin after years of elevated inflation and rising mortgage costs. But here is what the American audience needs to understand. Because this story is not just a Canadian problem, and it never was. The same analysis that calculated the damage to Canada also calculated the damage to the United States, and the number is $1.3 trillion worth of economic shrinkage that Americans themselves absorb from these tariffs, amounting to roughly $1,300 per American per year. The tariff is not a tax on Canada. It is a tax on everyone, and the American consumer is paying it every single time. They buy a product that contains steel or aluminum or auto parts that used to cross the border freely. American businesses that depend on Canadian inputs are already seeing their costs rise, and those costs get passed directly to the consumer at the checkout counter and on the car lot and in the grocery store. The supply chains that were built over 30 years of NAFTA and then CUSMA do not get rebuilt overnight, and while they are being dismantled, the inefficiency of that dismantling is pure cost that falls on ordinary people on both sides of the border. The U.S. Commerce Department has expanded steel and aluminum tariffs to cover 407 product categories, including appliances, rail cars, electric vehicle parts, wind turbines, mobile cranes, and more. And these products now face a 50% tariff on their steel and aluminum content. Think about what that means for an American family trying to buy a new washing machine or a new car, or for an American construction company trying to price out a project that requires structural steel. Those numbers have all moved in the wrong direction, and they moved because of a policy decision, not because of any natural economic force. Trump's provocations go beyond tariffs and beyond trade, because the explicit suggestion that Canada could or should become the 51st state of the United States is not just geopolitical theater. It is a calculated psychological operation designed to destabilize Canadian confidence and fracture the political consensus around how to respond when a sitting president of your largest trading partner questions the legitimacy of your national existence. It does not just create diplomatic tension, it creates business uncertainty at a scale that is almost impossible to quantify. And that uncertainty is doing something very specific to markets. Right now, it is freezing decision-making at exactly the moment when bold decisions are needed. Most Canadian businesses cannot plan supply chains when they do not know if a new trade agreement will be signed or abandoned. Canadian manufacturers cannot commit to equipment purchases when they do not know what the tariff environment will look like in 6 months. And American businesses that rely on Canadian inputs cannot lock in long-term contracts when the rules of trade keep shifting. Canada's finance minister has now publicly acknowledged that a baseline tariff on Canadian exports to the United States may simply be a permanent feature of the new trade landscape, something Canada will have to pay indefinitely just to maintain access to a market it helped build. That statement is not just an economic assessment, it is a concession, and it reflects how dramatically the leverage in this relationship has shifted. The markets have registered all of this. The Canadian dollar has been under sustained pressure. The bond market is pricing in prolonged modest growth, and equity markets in Canada are navigating a reality where the earnings outlook for manufacturing and export-heavy companies has been structurally revised downward. When institutional investors look at Canada today, they see a country with sound fundamentals and a resilient consumer base, but they also see a country that is being systematically squeezed by a neighbor that has decided to treat trade as a zero-sum contest. And ordinary Canadians feel this in ways that do not always show up in GDP reports. Residential investment fell 4.4% in Q4, which means fewer new homes, fewer construction jobs, and fewer opportunities for the young workers who are hoping to enter a housing market that was already almost completely unaffordable. When you layer a trade war on top of a housing crisis, on top of elevated inflation, on top of stagnant wage growth, outside of the headline averages, you get a population that is not in the mood for optimism. And that shift in collective mood has its own economic consequences. Because confidence drives spending, and spending drives growth. The United States is not immune to what comes next. Either because Canada has been a deeply loyal trade partner that quietly subsidized American prosperity in dozens of ways that rarely get acknowledged. Canadian energy kept American homes heated at prices below what they would otherwise have been. Canadian steel went into American infrastructure projects. Canadian auto parts made American vehicles cost less to manufacture, and Canadian agricultural exports fed American families. Any removal of that partnership does not just hurt Canada. It erodes the foundations of American competitiveness in a global market where Europe and China are not standing still. Here is the final truth that cuts through all the political noise on both sides of this conflict. The people who will pay the highest price for this trade war are not the politicians who designed it, and they are not the executives who can restructure supply chains and absorb short-term losses through capital reserves. They are the auto worker in Windsor and the steel worker in Pittsburgh and the small business owner in Calgary and the farmer in Iowa who suddenly finds that their canola or soybean or wheat faces retaliatory tariffs from countries that were pushed into those retaliatory positions by decisions made far above their pay grade. The inventory drawdown that triggered Canada's Q4 contraction is a visible scar left by an invisible war, and that war is not over. It is not even close to over. And the next chapter of this story will be written in the economic data that comes out over the next 6 to 12 months as the full weight of permanent structural disruption makes itself felt in employment numbers and household incomes and business investment figures across an economy that deserved better than this. The shelves will eventually be restocked, but the question of what fills them and who pays for them and under what terms has never been more uncertain. And the answer to that question will define the economic reality for millions of people on both sides of a border that used to represent partnership and now increasingly represents the front line of a conflict that nobody outside of Washington actually asked for. Statistics Canada released the fourth quarter GDP data, and the result was a 0.6% contraction. The kind of number that in normal times would raise eyebrows, but in the current environment, where US tariffs are already squeezing Canadian exports and business confidence is fragile, this number lands like a warning shot. The main engine behind this contraction was not consumer spending, which actually held up surprisingly well. It was not a collapse in services or a banking crisis. It was businesses drawing down their inventories at a pace that ripped nearly 5.6 percentage points straight out of GDP growth. And when you see a single component of an economy do that kind of damage in a single quarter, you have to stop and ask yourself, how did we get here? Let us go back a little, because this story did not start in Q4 of 2025. It started much earlier when businesses across Canada saw the trade war with the United States coming and made a very rational decision. They decided to stockpile goods before the tariffs hit, and that decision caused inventories to surge by almost unimaginable amounts in early 2025. We're talking about increases of over 3,000% and over 7,000% in consecutive quarters, and those numbers sound insane because they are insane. They represent a kind of economic panic buying at the corporate level, where companies were essentially hoarding supplies and raw materials to protect themselves from what was coming. And then the reversal happened, because it always does. Once those stockpiles were full, once the shelves in warehouses across the country were stacked from floor to ceiling with goods that had been rushed in before the tariff wall went up, businesses stopped buying, they stopped ordering, they stopped restocking, and instead, they just started selling down what they already had. That is the inventory drawdown. And it is brutal for GDP, because GDP measures economic activity, and if companies are not ordering new goods, they are not creating new activity, even if the shelves still look full from the outside. Here is a question for you. In the comments right now, do you think Canada's government acted fast enough to protect businesses from the impact of US tariffs, or did they wait too long? Write your answer below, because this matters and your perspective is important. Now let us talk about what makes this situation genuinely alarming, because there is a difference between a slowdown that is painful and temporary and a slowdown that signals deeper structural damage. And right now, Canada is dangerously close to the second category. The Bank of Canada has already acknowledged in its January 2026 monetary policy report that US trade restrictions have disrupted the Canadian economy in ways that will take time to unwind. And the projection going forward is GDP growth of just 1.1% for 2026 and 1.5% for 2027. Those are not numbers that inspire confidence when you're trying to rebuild momentum after a contraction. But here is what makes it worse. Non-residential investment in equipment and machinery dropped by 5.5% in the fourth quarter, and that category matters enormously because it represents businesses making long-term bets on the future. When companies stop buying machines and equipment, it means they have stopped believing in growth. And when that belief disappears, it does not come back overnight. The apartment and housing construction sector also pulled GDP downward in the final months of last year. And when you combine that with the inventory collapse and the equipment investment pullback, you start to see a picture of an economy that is contracting from multiple directions. At once, not just one isolated problem, but a convergence of pressures all landing at the same time. Ontario and Quebec are bearing the heaviest weight of this trade shock because they are the most directly exposed to the US economy. Southwestern Ontario, in particular, is feeling the full force of the tariff pressure, with manufacturing communities that built their entire economic identity around cross-border trade, now facing a reality where that trade is being deliberately disrupted by policy decisions made in Washington. And the United States is not backing down. President Trump's administration has made it absolutely clear that tariffs are not a negotiating tactic. They are a policy position. And Canada has been forced to respond with counter-tariffs of its own, which have now been largely absorbed into domestic prices, meaning Canadian consumers are already paying more for goods without necessarily connecting those higher prices to the trade war happening in the background. So let me ask you this, because I genuinely want to know, what do you think is the bigger threat to Canada's economy right now? The inventory crisis we just experienced, or the long-term impact of ongoing US tariffs? Leave your answer in the comments and explain your thinking, because these are not simple questions and there is no single right answer. Here is something that gets almost no attention in the mainstream conversation about Canada's economy, and it is the divide between provinces that are suffering and provinces that are actually doing fine. Alberta and Saskatchewan are largely insulated from the trade conflict because their economies run on energy and agricultural output. Those sectors face their own challenges, including Chinese tariffs on agricultural exports. But they are fundamentally different beasts from the manufacturing-dependent economies of central Canada. And this divergence is creating a Canada that is not experiencing one economic story, but two very different ones simultaneously. In the West, you have provinces that are growing faster than the national average, supported by oil pipelines that are finally operational and farmland that continues to produce at scale, while in Ontario and Quebec, workers in auto plants and steel mills are staring at an uncertain future as the trade relationship with their largest and closest partner becomes something that nobody can reliably predict. The disposable income numbers in Q4 actually told a more complicated story than the headline GDP figure, because household income grew at an annualized rate of 12.4% in that quarter, which is remarkable and suggests that individual Canadians are not yet in full crisis mode. Consumer spending held up, and final domestic demand actually bounced back after declining in the prior quarter. So the person on the street in Canada is not sitting in absolute despair, but that consumer resilience is operating on borrowed time. If businesses continue to delay investment, if inventories stay depleted and restocking, activity remains weak, then the jobs and wages that are currently supporting household spending will start to come under pressure in the months ahead. The inventory cycle is a lagging signal. What we are seeing in the data today reflects decisions that were made 6 to 12 months ago, and the decisions being made right now by business leaders across Canada are shaped by an environment of maximum uncertainty. Nobody knows when the tariff situation will be resolved. Nobody knows what the next policy announcement from Washington will contain. And in that environment, the rational choice for any business is to wait. And waiting means not hiring, not investing, not restocking, and not growing. That collective waiting is what economists call demand destruction, and it is the quiet killer of economic expansion. Canada is also dealing with something that does not get enough credit in these conversations, which is the psychological damage of sustained uncertainty. There is a well-documented phenomenon in economics where even if conditions improve on paper, the memory of instability keeps businesses and consumers cautious for far longer than the actual instability lasted. And Canada has now been living under the shadow of trade war threats for over a year. That shadow does not lift the moment a deal is announced. The Bank of Canada is managing inflation carefully, trying to keep it close to that 2% target, while also not cutting rates so aggressively that it inflates away any possibility of meaningful recovery. But the tools of monetary policy have limits, especially when the core problem is geopolitical and not financial. You cannot cut interest rates low enough to make a tariff disappear. There is a version of this story that ends with Canada coming out stronger on the other side as a more diversified economy, less dependent on American goodwill, with deeper trade relationships in Europe and Asia already being built. And there are real signs that this diversification is underway. But diversification takes years, and the pain of the transition is happening right now, today, in communities that cannot wait for a 5-year strategic pivot. And where are you watching this from? Right now. Drop your location in the comments. We want to know which part of the world is following this story and what the economic picture looks like where you are. What Canada is facing is not a temporary blip. It is the beginning of a structural renegotiation of its economic identity. And that process, by definition, involves disruption costs and a period where the old model no longer works and the new model is not yet fully built. The inventory data is a symptom, not the disease. The disease is a dependency on a single trade relationship that has been deliberately and systematically weaponized, and the cure requires Canada to do something it has historically struggled to do, which is move fast, make bold decisions, and accept short-term pain in exchange for long-term resilience. The question is not whether Canada can rebuild its economic model. The question is whether it can do it quickly enough to protect the workers and communities that are absorbing the cost of that transformation right now, before the next GDP report lands and tells another story of contraction. The clock is running and the inventory shelves are emptying, and what fills them next will say everything about what kind of economy Canada chooses to build from here.